But now it's time to welcome our first guest, Jon Najarian. Jon began his career as an options trader in 1981, following a stint as a pro football player. He now runs his own investing education website, Investitute.com, and is the author of the book, How I Trade Options. He's also regular on CNBC's Fast Money and is always in demand as a speaker and market analyst. Jon, I know it's only been a few weeks, but welcome once again back to the show. We're really happy to have you.
Great to be back with you, David. Thank you very much.
So I have to ask, where are you? What is all that we see in the background?
Yeah, that's O'Hare Airport. Little flight delay. It's that time of year. It's not just Christmas and heading into the holidays, but it's also the time when we get flight delays. So your guys are very accommodating, and we made it work.
Well, that's great. Well, you're very accommodating. We appreciate you being in the airport there, and hopefully we don't get any smart aleck making rabbit ears behind you there while you're on television. But when we spoke just a few weeks ago, you were pretty optimistic about 2019. And you said, gosh, if we see President Xi and we see President Trump shaking hands at the G20 summit, that would be a good thing, something to be optimistic about. And that pretty much happened. Some pretty good news coming out of there. But yet the volatility hasn't gotten any better. In many ways, it's gotten worse since then. What do you make of that?
Yeah. Well, I think, David, it's because at first, right after that handshake that you described, the Chinese didn't admit anything. And I don't mean admitting they steal technology or anything like that. I mean, they didn't even acknowledge anything happened in the meeting at all for basically 5 days. And that really caused people to start speculating as to whether President Trump might have stretched the truth a little bit. Then they finally started admitting, yes, we're going to start buying soybeans. Yes, we're going to start doing natural gas, liquefied natural gas purchases again. And that was the first time we really had a positive from what we thought was a very positive meeting that would lead towards a 90-day cooling off period and all that. So once we got that behind us, the volatility for that particular segment of the market came down. But then, of course, as you say, we got a whole bunch of other stuff, David, thrown at us from Theresa May over in the UK. We also had Jay Powell, our Fed chairman, back and forth with some comments that people worried about exactly where the economy was, and thus the volatility you just addressed.
Mm-hmm. So you're pretty optimistic about 2019, but for this block, just sticking with the whole tariff and the whole trade war issue, in the last minute or so we have in this segment, tell us, obviously if within 90 days there's a deal that's struck that's at least in the middle or goes toward our side of the game board a little bit, that's good for the markets. But what if we don't get a deal within the 90 days? Then what do you see happening as 2019 unfolds in the markets?
Well, yeah, if we don't get that, David, then I think big industrial companies that get 60% of their revenue overseas, not all of it from China, of course, but I think it hurts all of the trading partners. So if we don't, after 90 days, reach some sort of an agreement and a ratcheting back, for instance, of tariffs in particular, like right now, China's talking about cutting the tariff from 40% to 15% for imported autos from the U.S., that's a positive step. If we don't get anything more than that, then I think we're right back to, who blinks first? Does the president blink or does China blink? And those games of chicken can be pretty dangerous.
Yeah, it's interesting. A lot of people say, we can win the trade war because our markets seem to be saying so versus how the Chinese markets have reacted. But it's hard to win a trade war. So stay with us, Jon. Again, we appreciate you taking some time there at Chicago O'Hare. And you stay with us, too. We'll be right back with more words of wisdom from our good friend, Jon Najarian, on the Income Generation. But right now, it's time to welcome back our good friend, Jon Najarian. You mentioned, when we were together just a few weeks ago, that I mentioned the possibility of a flat yield curve, and you said, well, a flat yield curve, of course, is never a good thing for the economy, but it's not flat yet. And of course, that seems to have changed a little bit. It got a lot flatter just over the last few weeks, But then, almost at the same time, Powell, in response to that, said, well, all of a sudden there's a more dovish tone where, maybe they won't try to hike rates 3 times next year. What do you make of all this? And when you put all this in the big blender and push the button, what comes out?
Well, just like you're saying, David, the issues here are, that we just talked about trade. Now we're talking about the Fed and whether or not the yield curve is inverted by the Fed or by traders that anticipate the rates are going up, because it could invert either way. The information that we have right now from the Fed is that they're not going to be as aggressive as people feared. Goldman Sachs had, of course, four, count them, rate hikes on the table for 2019. Now they've cut that back to 1. So I think we're not going to be dialing in as much on the short-term boost to interest rates. That's good in terms of not inverting the yield curve. And, this was just one other thing, that the volatility you spoke of at the top of the show, where we're saying we've had the 200-day moving average, which of course is a smoothed average for technicians to look at for where the market is. We rolled over on that. All of a sudden, we were very close to an inverted yield curve. And then we had the issue with China, and China not admitting that we had a deal, at least for a cooling off period. All of that hit the market at once. So pulling out each one of those pieces like you just did with the Fed, yes, it is important that we don't continue to see rate hikes in the short term. And if we don't, I think longer term, like 12 to 18 months, we're going to do very well in the market. I worried that the Fed might overstep. Now I've pulled back and I'm more sanguine about it and optimistic.
So in other words, if the Fed stays out of the way of the markets, that's a good thing. I want to get your take on this, because you mentioned that the Fed could create the flat yield curve by increasing short-term rates, or that traders can create it. A few weeks ago, we had Mohamed Al-Arian on the show, who says, well, if a flat yield curve is created artificially through something like that, then he's not worried about it. When he worries about a flat yield curve is when the long end of it comes down, because we're just not getting the growth that we need to be getting. And I've been looking at it as a flat yield curve and is bad no matter what. In the last minute or so we have in the segment, what's your take on that? Do you have an opinion on that?
Yeah, I think it's bad no matter who does it. Traders, of course, they wouldn't do it to hurt the market. Traders would do it because they anticipate that they're looking forward 3 months, 6 months, a year into the future, and that's what traders do. Real traders now, computers and algorithms, they trade second by second, minute by minute. Different story. So Mohamed Al-Arian, who I respect a lot, is absolutely right. It doesn't matter which one of those two forces is at work to lift interest rates. If they're both not in the camp of lifting interest rates, because either they're anticipating it in the case of traders, or in the case of the Fed anticipating inflation, or employment data that tells them that they have to increase interest rates to slow things down to a simmer. If neither of those two are happening, then I think we're just fine. And Mohamed Al-Arian, very smart guy over there at PIMCO, I think he's spot on.
Yeah, I'm certainly not going to argue with Mr. Al-Arian when it comes to economic issues, and as a trader,
Sure.
you'd probably agree with that sentiment. We need to leave it here for this segment, John. We'll be right back, though. And you stay with us, too. We'll be back with more from Jon Najarian on the income generation. I'm David Scranton. But right now, it's time to welcome back for one final segment our good friend, Jon Najarian, reporting in from Chicago O'Hare Airport. John, you mentioned just before the break there that the trading, the algorithms, and I know you've written about that recently. I'm thinking that the reason the markets, I'm looking at the markets having turned, I said, gosh, first half of the year, the market shrugged off all the bad news, focused on the good news. Now they're shrugging off all the good news, focusing on the bad news. You think it's the algos. Talk about that.
I think they're certainly contributing to it, Dave. I think the issue is that we always know that markets take the stairs up and the elevator down. We go down much faster than we go up. And that's just a fact in non-computerized markets like in the 1920s all the way through the 1990s. But now that we've reached these near speed of light trading through algorithms, it's even more so. And I think that the market did, as you say, dismiss a lot of the bad news in the first part of the year, but it wasn't as much and all at the same time. We'd have to deal with one of those issues, and then we'd have a quarter, and then we'd deal with another issue. We didn't deal with, like I say, the 200-day rolling over for the S&P, the Fed maybe getting a little overzealous, and China basically not admitting that we actually had any kind of constructive talks.
Right.
We got all that at one time, and that's why the algorithms just went wild to the downside. I think a lot of those asset managers that follow those kinds of trading will have done very well, even though it hurt you and me and most of your listeners.
It's the perfect storm in many ways, which you described. So, we always talk in the show about people part of the income generation, retired or within 10 years of retirement, needing to protect their money. In the final minute or so, though, please tell us, is this a good time? If somebody wants to protect their money, they can't really protect it with call options, but right now with the volatility, it seems like, gosh, I could increase my income writing call options, the premiums must be up, and I may not protect my downside, but at least I'll increase my income. 45 seconds.
Right.
What do you think if people want to stay in the market but be conservative?
Well, just like you're saying in the name of your show, income generation. I would definitely do that. You're right. Volatilities are higher, which means you're getting a better premium. You're collecting like Warren Buffett likes to do. When he sells premiums, he's collecting on those premiums. He's not paying them out. And lastly, I'd say a lot of folks might want to pull a little stock off the table and instead put on some call spreads or simulate the position, the long position, through an option program of one type or another. Not enough time to cover all of it now.
Of course not.
But that'd be a great way to have major assets on the side and still be in the market.
Take some off the table, increase your income with covered calls, and simulate some equity holdings with options exposure. Jon, thank you very much. Have a great flight. It's great having you. And you stay with us here on The Income Generation. We'll be right back.